Welcome to today's What Will Move the Market show. I'm your host Prem. It's Friday, February 6th, 2026, and here is everything you need to know as the markets open for today. Overnight on Wall Street, it was another risk-off session and a third straight day of losses for US equities. The Dow Jones Industrial Average fell about 1.2% to close near 48,909. The S&P 500 dropped roughly 1.23% to finish around 6,798, and the Nasdaq 100 slid about 1.38%, ending close to 24,549. The big drag again was the high-growth technology and AI basket, where investors are increasingly worried about how massive capital expenditure plans will weigh on near-term cash flows. Earnings commentary from the mega-cap tech names has been strong on revenue but heavy on spending, and that is prompting a rotation out of the most richly valued leaders. At the same time, recent US labor and layoff headlines have added to concerns that growth momentum may cool later in the year, keeping the mood cautious across risk assets. In terms of sector moves, large-cap tech, communication services and parts of consumer discretionary led the slide, while more defensive pockets such as staples and utilities held up relatively better. Chip makers and cloud-linked names bore the brunt of the selling, and several AI-themed stocks continued to give up gains after a very strong run over the past year. On the other hand, some traditional value and dividend names saw comparatively smaller declines as money sought safety. Crypto assets also remained under pressure, with traders cutting risk across the board. After the closing bell, earnings reactions stayed mixed, and while there were a few stock-specific rebounds, the broader after-hours tone still reflected caution, rather than a clear turnaround. Now let's look at what the Indian ADRs are telling us about foreign investor appetite. Infosys Limited's ADR closed at about $16.8, up around 0.36%, suggesting mild buying interest in Indian IT, despite the broader tech sell-off in the US. HDFC Bank's ADR ended the session near $33.99, up roughly 0.12%, signaling steady foreign confidence in quality private sector banks. ICICI Bank's ADR finished around $30.88, down only about 0.13%, indicating largely flat sentiment rather than any aggressive selling. Reliance Industries, sponsored GDR listed overseas, closed close to $63.8, down about 0.78%. The overall ADR picture points to banks looking more resilient than energy and showing better relative strength than some domestic cyclicals, which could be an early cue for today's sector leadership on Dalal Street. Shifting focus to Asia, remember that at this hour we mostly work with the latest closing levels rather than live intraday moves. As of the most recent close, Japan's Nikkei benchmark is actually in positive territory. The Japan 225 gauge finished around 54,100, up about 0.62%, helped by select exporters and a constructive local backdrop despite the US wobble. In Hong Kong, the Hang Seng barometer closed near 26,490, gaining roughly 0.37% and extending its recent recovery from deeply oversold levels. On the mainland, the Shanghai Composite Total Return Index ended around 4,682, up about 0.20%, showing a modest bid in Chinese equities after a period of sustained weakness. These are previous session closes. Fresh live trading moves through the Asian day will determine whether this tentative resilience holds in the face of US pressure. For India, the key early indicator is Gift Nifty, which trades almost round the clock in Gift City. The latest available reading for the Gift Nifty 50 futures is around 25,630, down roughly 0.27%. That implies a soft to mildly negative start for the Nifty 50 cash index, very much in line with the weak cues from Wall Street, though not signaling outright panic. Taken together, a firmer Japan, a constructive though still fragile Hong Kong, and a slightly positive Shanghai close suggest that Asia is trying to stabilize, but the overnight slide in US indices will likely cap any aggressive upside at our open. On the global macro and geopolitical front, the market narrative remains dominated by three big themes. First, central banks, particularly the US Federal Reserve, are still in a holding pattern, and markets are constantly repricing the timing and magnitude of rate cuts based on every new piece of growth and inflation data. That keeps bond yields choppy and feeds into valuations for growth stocks worldwide. Second, oil market traders are focused on developments in the Middle East and diplomatic efforts involving the US and Iran, which have helped cool some of the recent geopolitical risk premium in crude prices. Third, the new India-US trade deal is in focus, with Washington agreeing to significantly lower tariffs on a basket of Indian exports, and President Donald Trump repeatedly highlighting India as a key strategic and economic partner in his social media messaging. For Indian markets, that combination of trade tailwinds and shifting global growth expectations will be important for export-oriented sectors like engineering, specialty chemicals, textiles, and renewable-linked manufacturing over the medium term. Back home, domestic factors will again play a crucial role in how the session unfolds. The RBI's Monetary Policy Committee meets today, and the policy announcement is scheduled for later in the morning. With inflation broadly within the target band and growth holding up reasonably well, street consensus is for the repo rate to be kept unchanged with a neutral stance, but traders will be listening closely to the tone of the commentary on liquidity, growth risks, and how global volatility is being assessed. On the regulatory side, SEBI has recently reinforced its existing approach to derivatives by tightening order-to-trade norms and overall F&O risk controls. But importantly, it has indicated that no fresh near-term curbs or expiry day changes are on the cards beyond what has already been communicated. Let's talk technicals for the key indices. For the Nifty 50, traders are broadly watching the 25,600 to 25,500 band as immediate support, with a stronger base down toward the mid-25,400s. On the upside, resistance is seen first near 25,800 and then at the psychologically important 26,000 mark. Price action over the last few sessions suggests a consolidation just below recent highs, and a break on either side of this range could set the direction for the next leg, especially once the RBI policy is out of the way. For Bank Nifty, the near-term support zone sits around 59,800 to 59,400, while resistance is placed near 60,400 and then 61,000. How the index behaves around these levels will tell us whether financials are gearing up for another leg of outperformance or preparing for a deeper bout of profit booking after a strong run. Moving to commodities, which often drive sentiment for key Indian sectors, gold is once again firm. CFDs on gold are trading around $4,821 per ounce, up close to 0.92%. That strength reflects ongoing demand for safe haven assets amid equity volatility and geopolitical noise. Silver is even stronger in percentage terms, with its CFD level near $72.13 per ounce, up about 1.68%, signaling renewed interest in precious metals after recent choppy moves. In energy, WTI crude oil is hovering near $63.52 a barrel, up roughly 0.65%, as traders balance softer growth worries against geopolitics and OPEC supply signals. Given all these moving parts, how should you think about the day ahead? With US markets under pressure, Gift Nifty pointing to a softer open, and a major domestic event in the form of the RBI policy, today is a day for disciplined, risk-aware trading rather than aggressive bets. Short-term traders may want to keep position sizes modest, avoid over-leveraging in index futures, and be very clear about stop-loss levels, especially around the policy announcement window when intraday volatility can spike. It can help to focus on relative strength, stocks and sectors where price action and fundamentals are aligned, rather than trying to pick exact bottoms in the weakest names. Longer-term investors can treat global corrections as opportunities, but even then, a staggered systematic approach to adding quality stocks tends to work better than lump-sum buying on a single volatile morning. That's it for this morning's edition of What Will Move the Market. Stay tuned for the evening wrap, where we'll break down how the RBI decision, global cues, and sector trends actually played out through the day. Send in your questions, tell us which stocks or themes you'd like us to cover next, and don't forget to subscribe to this podcast so you can join us every day before the opening bell.